Welcome to The Explainer, where we're breaking down the high-stakes world of real estate finance. You know, there's one critical detail in a loan agreement that can literally make or break an investor's entire portfolio. And today, we're getting into it.
So let's start with the billion-dollar question, right? It's the one every single real estate investor has in the back of their mind when they're signing that mountain of paperwork for a loan. If this all goes sideways, how much am I really on the hook for?
All right, here's how we're going to tackle this. First, we'll talk about that walkaway dream. Then, we'll get into the nuts and bolts of recourse versus non-recourse loans. After that, the really juicy part, the hidden clauses that change everything. We'll then look at how you actually choose a loan and wrap it all up with a big question. What is this protection really worth?
So first up, let's explore what every investor is hoping for. I'm talking about that financial safety net, the one that shields your personal wealth if a property deal completely tanks. This is the absolute core appeal of what we call non-recourse debt. I mean, on the surface, it sounds like the perfect deal, doesn't it? Your losses are limited to just the property you invested in, and that's it. It's the power to just walk away.
Okay, so that's the dream. Now, let's get real and break down the fundamental difference between the two main types of debt you're going to see out there in the world of commercial real estate.
The critical distinction here really boils down to one simple but massive question. Are your personal finances, your house, your savings, your other investments, on the chopping block if this deal fails? To make this crystal clear, let's just walk through an example. Let's say you took out a $5 million loan. The market takes a nosedive, you have to default, and the lender forecloses. But the property only sells for $3.5 million, leaving a $1.5 million gap. So what happens now? Well, with a recourse loan, that $1.5 million is still very much your problem. The lender can take you to court, get what's called a deficiency judgment, and legally come after your bank accounts, other properties you own, you name it.
Now, in the non-recourse world, the story seems way better. You hand the keys to the property back to the bank, and your liability ends right there. The lender eats that $1.5 million loss. It's their problem, not yours. Or so it seems.
And here it is. This is the big twist. And honestly, if you only remember one thing from this entire explainer, this should be it. The idea of a loan being truly non-recourse is, well, it's mostly a myth. That's because there are hidden tripwires, and even the most experienced investors can get totally blindsided if they don't comb through the fine print, because that walk-away promise, it comes with some major exceptions. They go by this kind of wild name, bad boy carve-outs. And what they are specific clauses that are written into every single non-recourse loan. If you do one of these bad acts, poof, the non-recourse protection vanishes, and suddenly that lender can come after all your personal assets. Hey, look, we're not talking about minor mistakes here. This is the serious stuff. We're talking about major breaches of trust. Things like committing fraud, pocketing rent money that should be going to pay the mortgage, or filing for bankruptcy just to stop a foreclosure. It's the lender's way of saying, hey, we'll take the market risk, but we are not going to take the risk of you being a bad actor. So knowing that even non-recourse loans have these hidden teeth, how do you strategically pick between the two? Because it's not always as simple as it sounds. You know, a lot of the time, the project itself kind of decides for you. If you've got a big, stable property that's already making money, you're a great candidate for a non-recourse loan. But if you're doing something riskier, like building from the ground up or a major renovation, lenders are almost always going to want you to have more skin in the game with a recourse loan. So why would anyone ever sign up for that personal risk? Well, there are actually some really compelling reasons. Lenders reward you for taking that risk with much better terms. We're talking lower interest rates, bigger loan amounts. And for a lot of these development projects, it's pretty much the only game in town. Right. This protection, it isn't free. You got to think of it like an insurance premium. You are typically paying a higher interest rate, maybe 1/4 to 0.5% more, for the privilege of that non-recourse safety net. You're paying the lender to take on the very market risk you're trying to get away from. And this brings us all the way to the final takeaway. See, this isn't just about a bunch of legal jargon in a contract. This is about making a calculated business decision where you have to weigh the risk against the reward. So before you sign a single thing, you absolutely have to do your homework. This checklist is non-negotiable. Get the full list of those bad boy carve-outs. See if you can negotiate the language on any of them and be crystal clear on who exactly is signing a personal guarantee and what it covers.
Just remember, non-recourse debt is there to protect you from market risk, the stuff you can't control. It is absolutely not a get-out-of-jail-free card for being a bad operator or making unethical choices. You still have to run the property like a professional.
Ultimately, it all comes down to this one question. You are paying for an option, the option to limit your liability, and you have to analyze the deal, the market, and your own stomach for risk to decide if the price of that protection is worth it, or if you're better off taking the risk to get a better deal. And the right answer? It's going to be different for every single deal.